Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help POA students like you ace their exams. Today we have got a practice question which requires you to prepare the journal entries for some transactions and also understand the effects on the accounting equation. Now, what is the accounting equation? The accounting equation is that total assets should always equal the total of capital plus the total of liabilities. This is the very foundation of the balance sheet which you are used to preparing. So you can see the question on the left hand side of your screen, and on the right hand side we have all the workings which I'll explain step by step. With that being said, let's begin. The following transactions took place during Hannah's third year of trading. So here we have got the first transaction. Hannah deposited $3,000 into the business bank account. Now let's look into the workings we've got on the right hand side. First of all, what is the accounting equation? The accounting equation stands for the total assets must always equal the total capital plus the total of liabilities. Capital is also known as the owner's equity. Now, how should we journalize this first transaction? When Hannah deposited $3,000 into the business bank account. When Hannah deposits $3,000 into the business bank account, our funds which are available in the bank account increases in value. Bank account in itself is an asset account, specifically a current asset account. When assets increase in value, we always debit them. Assets by default are also always debited, which means whenever they increase, we debit them. Okay? Now that our funds available in the bank account are increasing, our assets need to be debited, and therefore we will debit the cash at bank account by $3,000. Simultaneously, what's our credit entry? Our credit entry is the owner's equity that needs to increase by $3,000. Because when Hannah deposits $3,000 into the business bank account, this is referred to as a capital investment made by Hannah. And capital by default is always credited, which means when it increases, it's always credited. Therefore, we are crediting the account for capital, specifically the account of capital Hannah, by $3,000. All right. Now, based on this journal entry which we have just done, what's the effect on the accounting equation? When we are debiting the cash at bank account by $3,000, our assets are increasing by $3,000, specifically our current assets, right? And also at the same time, because Hannah invested her own money of $3,000, which is also referred to as owner's equity or capital, our owner's equity that we report in the balance sheet is also increasing in value by $3,000. Okay. Now let's look into the table which we have got for this question. For transaction one, you understand that for assets, for the non-current assets specifically, we have no effect, but for the current assets, it's increasing by $3,000 specifically because the cash at bank balance is increasing by $3,000. In the liabilities section, we have no effect for non-current or current liabilities, but for the owner's equity, which is also referred to as the capital, it's increasing by $3,000 simply because Hannah started this business with $3,000 of her personal funds. Okay? All right. Now, so let's look into the second transaction which we have got. Repaid a 3-year business bank loan of $5,000 using her personal check. All right. So you can see that I have highlighted some keywords here, which is the 3-year bank loan, and also then I've highlighted personal check. Now, how should we journalize the second transaction? First of all, bank loan in itself is a non-current liability. And we know this is a non-current liability because the question clearly mentions 3-year, which means this is not really repaid in 12 months, but rather this could be repaid over multiple periods, right? Now we have repaid this bank loan, our liabilities or obligation goes down in value. Liabilities by default are credited, which means when they increase, we credit them. Now that we have paid off the bank loan, our liabilities must go down in value, and therefore we have to debit the bank loan by $5,000. Okay? At the same time, the question also mentions using her personal money or personal check. This is referring to the fact that Hannah, in fact, have made an investment by using her personal money to pay off this bank loan. When her personal funds are used to pay off this bank loan, Hannah's capital, which is also referred to as the owner's equity, is increasing in value, and therefore we will credit the capital account for Hannah by $5,000. Okay? So, what's the effect on the accounting equation? First of all, when we are paying off the bank loan, which is a non current liability in itself, specifically due to those words 3 year, okay, so we can confidently say it's a non current liability. When we are paying off this bank loan, our non current liabilities are decreasing by 5,000. And at the same time, because Hannah is using her personal funds, the capital available for investment within the business is also increasing by 5,000. Therefore, the owner's equity is increasing by 5,000. All right. Now, what about the effects on assets? There is no effect on assets. Why? Because we know that assets equal to capital plus liabilities. Now, if liabilities are decreasing by 5,000 when the capital is increasing by 5,000, then both of them cancels out each other, and therefore the net effect on assets is essentially zero. Okay? Now, how should we fill in this table? So in this table, we understand that there is no effect on non-current assets. I'm just writing NE in short, nor there is any effect on current assets. But for the liabilities section, we understand that non-current liabilities are decreasing by 5,000. Okay. And for the current liabilities, we've got no effect. But for the owner's equity, it's increasing by 5,000 simply because Hannah used her own money, which is seen as some form of capital contribution, to pay off this long-term liability or bank loan. Okay? All right. Now that we are clear with the second transaction, let's look into transaction number 3. Purchased a machinery for the business costing $23,000 by check drawn on the business bank account for $3,000. The balance will be paid within 4 months. All right. What this transaction simply means is that we bought a non-current asset which had a total cost of $23,000. We used our own business money. The amount used is $3,000 to pay off this asset, and the remaining $20,000 is to be paid later. All right, so we have actually used our own funds, and at the same time, we have also bought this asset on credit. So what's really happening here? So how should we journalize them? When we are buying the asset, which is the machinery, our assets are increasing in value. When assets increase, we always debit them. So we are debiting machinery by $23,000. At the same time, we have used our funds available in the bank account, which means our current assets, which refers to the funds available in our bank account, are decreasing in value. And we used $3,000 from our bank account, as the question clearly mentions, right? Therefore, because our bank account is decreasing by $3,000 in value, we will credit the cash at bank account by $3,000. We know the balance, which is $20,000, is what we will pay later. So at the moment, this is a present obligation. And since this is to be paid in 4 months, this is what falls within the definition of a current liability, because we have to clear this payment within 4 months. And when liabilities increase, we credit them. So that's why we are crediting other payables, not trade payables, but other payables. Why other payables? Because trade payables refer to credit purchases of inventory from your credit supplier. But machinery here is a non-current asset account. You're not buying it to sell it later to your customers. You're buying it for the purpose of helping you run your business operations. So therefore, the correct terminology in this case is to use other payables. All right. So we are crediting other payables by $20,000, which is increasing our liability by $20,000, specifically the current liabilities. Okay. Now, what's the effect on the accounting equation? First of all, when we are buying machinery for a total cost of $23,000, our non-current assets, which we will report in the balance sheet, are increasing by $23,000. We can confidently say that, right? And then we know that we have used $3,000 from our bank account to partially finance this machine, right? So bank account is a current asset account in itself. So when we have used $3,000 from a bank account, it goes down in value, and as a result of which current assets are decreasing by 3,000. Simultaneously, we know $20,000 is partially financed through some kind of credit arrangement where we will repay our obligation within 4 months' time. So therefore, it is a current liability which is increasing by $20,000. Okay. Now, how should we fill in this table here? First of all, we understand that non-current assets are increasing by $23,000, which is the cost of the machinery bought. Current assets are decreasing by $3,000 because we have used $3,000 from our cash at bank account. In the liabilities section, there is no effect on non-current liabilities, but our current liabilities are increasing by 20,000. And the reason this is a current liability is because we will make this repayment in 4 months' time. That's the agreement on which this machine was bought. All right. For the owner's equity, there is no effect, as you can understand based on the journal entry which we have done, and also the explanation on the effects for the accounting equation. All right. Okay. So the last transaction for today. Settled an amount owed to supplier of 8,000 less 5% cash discount. Now the question clearly mentions the word supplier, all right? Which means we are used to buying inventory on credit from our suppliers with a promise to make the payment later in the future. So in this case, we're actually making a payment, and when we are making the payment, we're getting some kind of cash discount, which is 5%. Now, the original amount that we used to owe our credit supplier is $8,000. Credit supplier is also referred to as the trade payables, right? Trade payables or the credit suppliers are originally our current liabilities. Now that we are paying them off, they're no longer going to be our liabilities. Therefore, liabilities are decreasing in value. When liabilities increase, we credit them. But now that they're decreasing, we will debit them. So that is why we debit the account for trade payables by 8,000. Okay? Now, what's the amount of discount we got when making this payment? The discount is 5%, which the question states. And the original amount we used to owe our trade payables was 8,000. So 5% of 8,000 is 400, which is a discount we expect to receive when we're making this payment. When we're receiving the discount when making this payment and the amount is $400, this is an income for us, specifically an other income, because we're saving money. We're saving $400, right? So therefore, because it's an income, we have to credit this income because by default, income accounts are always credited. That is why we are crediting the account for discount received by 400, and the balance which we will actually pay off using our funds available in the bank account is 7,600 after the 400 discount is deducted. And when we use our funds available in the bank account to pay this amount, bank account being an asset account goes down in value, and when assets go down in value, we credit them. So that is why we're crediting cash at bank by 7,600. Okay? Now the effect on the accounting equation. First of all, when we are debiting trade payables by $8,000, our current liabilities are decreasing by $8,000, right? Because we originally used to owe these guys $8,000, but when we made the payment, after the discount was factored in, we do not really owe them anything, so therefore we can confidently say that current liabilities are going down in value by $8,000. Then, when we are using our funds available in the bank account to make this payment, our current assets are going down because bank account is a current asset in itself. So current assets are going down by 7,600, which is the amount we have used to make this payment after the discount was received. And then at the same time, discount received is an income. That's the reason we credited it in our journal entry. But because it is an income, it's also going to increase our profits, right? And when our profits go up, our capital available goes up, or in other words, our owner's equity also goes up. So owner's equity will increase by 400. Okay. Now, how should we fill this in the table? First of all, we have got no effect for non-current assets, but for current assets, we know it's going down by 7,600. In the liabilities section, we have got no effect for non-current liabilities, but for current liabilities, it is going down by 8,000. What about the owner's equity? We know it's going up by 400 simply because we have got some kind of income which increases our profit, and when profit goes up, our capital available for investment goes up, and when capital available for investment goes up, our owner's equity also increases in value. All right? Okay. All right, so I believe that clears your confusion with regards to the journal entries and how the accounting question is affected. Thank you for watching this video, and if you found value in this content, make sure to drop a like and subscribe to this channel, and I'll see you in the next lesson.